If you want to understand your company's profitability, then you need the income statement. The income statement shows you your profitability for a period of time. It could be a day, it could be a week, a month, could be an entire quarter, or a year. For most small businesses, you're going to be looking at your income statement over the period of a month, and then you'll be sitting down with your accountant at the end of the year to look at the entire year. The income statement calculates profitability by adding up all of your sales in the period and then subtracting all of your expenses in the period. Sales minus expenses is equal to net income. If net income is positive, you're profitable. If net income is negative, then you've suffered a loss and you're not profitable. Let me show you a quick example. Let's say that in January we had a total sales of $10,000 and that all of our expenses added up to $8,500. If we subtract the $8,500 from $10,000, we'll end up with a net income of $1,500, which, because it's a positive number, means that we've been profitable. All right, so just before we go into showing you what a loss might look like, a couple of things to make this income statement look a little bit better. Anytime we have a mathematical function like adding some numbers or subtracting one number from another, we put a single line, which means here that the 10,000 gets subtracted from the 8,500 in order to equal the 1,500. And then at the bottom of any financial statement, the last number has two lines underneath it, a double underline. And now let's see what happens when our expenses are greater than our sales. Sales of 10,000, let's say expenses were 12,000. We're going to do some mathematics here. 10 minus 12 is equal to minus 2,000 with a double underline. That shows a loss. Sometimes losses aren't shown with a minus sign in front of them. Sometimes they're shown with brackets, and that means exactly the same thing. Sales, expenses, net income. So far, so good? All right, on to the next video.